Is SoFi a buy at $13.50 per share? And if you want to build indestructible generational wealth, is SoFi a good choice as a long-term investment? The only way to know is via fundamental analysis to find the intrinsic value. I spent the last week putting together a full fundamental analysis of SoFi stock based on their recently reported 1Q 2025 results. Trading at $13.50 per share, I have a buy rating on SoFi stock. In my research, I discovered 6 things that got me very excited and 6 red flags to watch out for with SoFi. So, what did I discover? What's my value for SoFi stock? And what's an ideal entry point should you decide to become a SoFi shareholder? Are you an investor in SoFi stock? Why or why not? Let me know in the comments below. In this video, I will cover SoFi's recent results and what everyone is missing, what I think about SoFi stock and what my analysis uncovered, what Wall Street smart money says and how it can impact your portfolio, and how you can use this information to build wealth and what you must do if you decide to buy. If you're enjoying this, please smash that like button. SoFi showed durable growth and strong returns in 1Q25, setting new records in both members and products. Let's cover the red flags first. Despite strong top-line growth, these segments are currently loss-making and may take years to scale profitably.
Credit card, we're still honing, we're still working on it. A lot of people don't realize this, but we lose over $100 million a year in invest in credit card. And that's profit that will come back to us as we scale, invest in credit card as we optimize the back book. So, we're investing a ton in our different businesses. Credit card's one where we're going to continue to be very methodical and make sure we bring in the right types of partners and customers there and fix the back book.
While SoFi is building for future profitability, the margin drag persists. A deteriorating consumer environment could stress SoFi's personal loan portfolio. Fortress, Blue Owl, and Morgan Stanley Investment Management were buyers, but a liquidity crunch could change this strategy.
At the same time that we decided to move away from smaller deals and focus on big financial institutions with bigger, stickier, long-term deals. I'm happy to say, the last 6 to 8 months have been very robust in terms of the demand.
SoFi faces scrutiny from CFPB, SEC, and potentially the DOE on its lending practices, particularly related to student loan refi and data monetization. One regulatory shift could reshape operations. Personal loans make up over 60% of total loans, adding concentration risk. If credit conditions deteriorate, this category could be highly exposed.
That's bad business.
Charge-offs on credit cards was 10.9%, down 15.7% year over year. While an improvement, this is still an area of concern. Share dilution remains a concern for long-term holders. Stock-based compensation expense in Q1 25 was $63.8 million.
That's a lot of money, boss.
Here's what got me really excited. SoFi posted $498.7 million of GAAP net income for fiscal year 2024 and $71 million in Q1 2025 alone. Deposits grew to $27.1 billion, funding the majority of SoFi's lending operations at a lower cost. This is what gives SoFi an edge over its fintech peers.
I got a ton of new tech.
The LPB model lets SoFi originate loans, sell them to institutions like Blue Owl and Fortress, and keep servicing rights.
The important part of our loans is they're durable through the cycle, because my view is we want to be able to sell those loans regardless of what environment that we're in. And so being able to maneuver in that environment is really critical to showing the durability of the loans and why our capital partners have remained.
SoFi now has over 10.9 million members, up 34% year over year. Member growth shows no signs of slowing. They added 800,000 in Q1 alone.
Growing our members 33 and our products 34%. We're growing revenue. It's accelerating. Our margins are expanding. It just really highlights the fact that the markets we're in, we're barely scratching the surface. And the more investment we put behind the business, the more we grow and the more profitable we become.
Contribution margin has nearly doubled, and profit has 4x'd from 37 million to 148 million year over year. This includes checking, savings, credit card, and invest products.
Sounds cool.
This is what everyone is missing. Lending products increased 25%, and financial services products increased 36% year over year. SoFi is no longer just a capital-intensive lender, but a high-margin financial services company.
Thanks for the info.
When it comes to any stock, I let the numbers tell the story, and that involves looking at a company's financial statements. Would you build a house without knowing the size, location, dimensions, or condition?
No, thank you.
That is what you are doing when you buy a stock without understanding the three financial statements. If you want to see what I teach the world's top financial analysts on Wall Street, check out my school community Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. We need to remember that as a bank, liabilities are assets and assets are liabilities. While a deposit is an asset to us, we can take it at any time, so it's a liability to a bank. While a loan is a liability to us, our payments are income for the bank, so it's an asset for them. SoFi has almost 26 billion in deposits. This is massively lowering their funding costs versus borrowing from capital markets, which means less need for debt. Debt decreased by over 2.1 billion since the company can fund the business through deposits. CEO Anthony Noto said,
"We've built $27 billion of deposits, and those are high-quality deposits. They're 90% of the $27 billion is from direct deposit customers. 97% of the deposits are insured, and that's a great backstop."
Retained earnings increased nearly 500 million from 2023 to 2024. In 2024, SoFi achieved its first full year of profitability. Retained earnings will continue to grow, which is huge. So what's the takeaway? SoFi's business is hitting its stride with deposits increasing, debt decreasing, and retained earnings moving in the right direction. The income statement shows us if a company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Including provision for credit losses, SoFi generated 2.7 billion of net revenue. Despite generating over 2 billion in 2023, SoFi was able to grow the top line 26%. EBITDA was positive for the entire year for the first time in 2024. EBITDA drives valuation. Positive and growing EBITDA means increasing valuation and a promising future. Net income was almost 500 million and positive for the first time in company history. Vision and plans don't matter, earnings do. This is a significant positive development for investors. So what's the takeaway? Massive revenue growth and cost efficiency drove EBITDA and earnings to be positive for the first time, and the future looks bright. The cash flow statement tells us where the cash is generated by the company, and there are three buckets. Operating, which is the cash the company generates internally. Investing, which is the cash demanded for long-term growth. Financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. Operating cash flow improved by 6.1 billion from 2023 to 2024. The operating cash flow is primarily driven by strong and positive net income that SoFi is generating. Investing cash flow is negative, which is expected, but there is a great reason why. SoFi is deploying its cash into available for sale investments, which provide a return for the company, while being very liquid, so they are easy to sell fast if needed. Financing cash flow is positive, which is rare, but not for a bank. As we mentioned earlier, assets are liabilities and liabilities are assets. This means financing cash flow is more like operating cash flow, since liabilities, deposits, fund the business, and increasing deposits means more funding, which means increasing cash flow. So what's the takeaway? While SoFi had a net cash outflow of 900 million in 2024, this is because the business is less reliant on debt and more reliant on deposits, which is a net positive for the company moving forward. So what do I think about SoFi and what should you do?
I've been waiting for this moment.
I'll get into that, but let's go through my valuation. On Wall Street, we build discounted cash flow models to measure the intrinsic value of companies. Because companies generate cash flow and we projected the three financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flow. If you want to learn how to build financial models like we do on Wall Street, scan the QR code on the screen to join my school community, Win Like Wall Street. Also, you could check out my step-by-step video I did on building a DCF model, which includes an Excel file. The link to that video appears above and is in the description. As you can see on the left, we take specific line items that we projected from the three financial statements. We use these items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get to total enterprise value. We strip out the debt, we add the cash, we strip out non controlling interest, we add associate investments, we get an intrinsic equity value of $23 billion. We divide by the current shares outstanding, we get an implied share price of 1943. Compared to the current close of 1332, that's almost a 46% discount, which is a screaming buy rating. So, what does Wall Street have to say about SoFi? Let's cover that next.
The wait is over.
The consensus among analysts is mixed, with some expressing optimism about SoFi's growth trajectory and diversified offerings, while others offer caution against potential overvaluation and ambitious targets. Barclays maintains an equal weight rating, indicating a neutral outlook. The firm suggests that SoFi's current valuation appropriately reflects its growth prospects and recommends investors hold existing positions. UBS maintains a neutral rating, acknowledging SoFi's solid performance, but expressing caution due to valuation concerns. The firm suggests that while SoFi has growth potential, the current stock price reflects much of this optimism. Needham maintains a bullish stance, citing SoFi's diversified financial services and technology platform, which are driving growth and profitability. The firm believes SoFi's comprehensive product suite positions it well for continued expansion. CapIQ gives me a sense of how other analysts on Wall Street view the company. 16 analysts cover SoFi on Wall Street. The target price ranges from a low of $6, which is a 55% decrease, to a high of $20, which is a 50% increase. So downside slightly outweighs upside. The median is 1427, which is a 7% increase. The overall rating on a scale of 1 to 5 is 2.74, which is a hold rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I personally do not have a position in SoFi, but this analysis had made me very positive on the stock. The following insights are what make me very bullish. SoFi's bank charter enables 85% loan funding through member deposits, drastically lowering its cost of capital.
So we have over $27 billion of deposits, over $14 billion of point-of-sale debit spending, and I think the sky's the limit in terms of there is no limit to where we can take that business and how differentiated it can be.
This structural advantage supports profitability and resilience in volatile markets. 42% of new loans in Q1 came from existing members. The all-in-one app is intentionally built to reduce friction.
We want to own our own technology because it allows us to innovate faster, it allows us to be a low-cost operator, which feeds those other two tenets of being best of breed and best unit economics, reinforcing highest lifetime value.
This dynamic supports high customer lifetime value and low churn. SoFi's tech arms, Galileo and Technisys, are landing major clients like the U.S. Treasury for Direct Express card processing.
We've announced a number of deals. The Direct Express deal is a huge home run for us. It's a diverse deal. It's a government-backed deal. It's got great visibility in terms of the revenue it will generate. We're investing heavily in that transition.
This segment scales without adding credit risk or capital intensity. SoFi originates loans and sells them to institutional buyers like Blue Owl and Fortress, keeping the servicing rights.
We generate about $120 billion of loan demand a year. We fulfill, call it $20 billion of that. That other $100 billion is very attractive to people, and so you'll see us expand into that area as well. But the market for the loan platform business is deeper and wider than we ever thought it was, and the fact that we have someone that's taking those loans before we've underwritten them gives us great visibility, and it generates a fee revenue stream.
The LPB is high margin, scalable, and mitigates balance sheet exposure. SoFi is reinvesting heavily in segments like SoFi Invest and credit cards, which are not yet profitable but show accelerating adoption.
Credit card, we're still honing, we're still working on it. A lot of people don't realize this, but we lose over $100 million a year in invest in credit card. And that's profit that will come back to us as we scale, invest in credit card as we optimize the back book. So, we're investing a ton in our different businesses. Credit card's one where we're going to continue to be very methodical and make sure we bring in the right types of partners and customers there and fix the back book.
These could be major profit centers in 3 to 5 years, driving long-term growth. SoFi hit an all-time high of 1842 back in late January, and it's down almost 28% since then. SoFi is sacrificing short-term profit for long-term growth as it positions itself to become the Amazon of fintech. 2024 was about margin expansion. 2025 will be about reinvesting in its Invest credit card and subscription services income streams. What this means is that the fundamentals will potentially suffer and cause investors to get a little skittish. But That will provide buying opportunities for long-term investors like us to jump in and take advantage of pullbacks. If you like this and want to see another in-depth stock valuation, check out my SoundHound video here or my Meta video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.